The market has definitely taken a turn for the bearish side, and we have something special to share with you on this webinar that you are not going to want to miss. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. Now, if you want to make sure that you're getting the most up-to-date current information on goings on in the market, I need you to get down there and smash that like and subscribe button. Click the little bell icon next to it to make sure you get notified every time we upload a new webinar or recording here on the Riz Elite YouTube channel. We have the man himself, the guy with the name on the side of the building. It's Riz Memon. How are you doing this evening, brother?
Doing good, Chris. Thank you for everything. Just wanted to start with that.
No, really appreciate it. Glad you can be here to kind of share your knowledge. I think that it's so great when you come on the webinar because you definitely have a different viewpoint than some of the other content creators out there. And we've got something a little different tonight. I know this isn't our usual version of the S&P 500 that we're looking at, but we wanted to highlight something very special this evening on the S&P 500. And this is something that typically only people who go through our our master class, or Riz's master class that is, will get access to. So Riz, why don't you explain this to us a little bit?
Yeah, Chris, thanks for the intro there. Yes. So what you're seeing, although the chart looked a little bit different than usual, I think this is a little bit more appealing on the eyes. But the key point of interest I want to draw your attention to is the arrows, the long, upwards arrows right there, the red or the green one, either pointing up or pointing down, respectively. And of course, the most recent one being the downward pointing arrow on August 9th. Wednesday, 9th of August, 2023. This one is considered to be a short signal. So the Alpha Cross Evo is the proprietary indicator that all masterclass students get access to, and obviously they can have real-time alerts on the indicator itself whenever it's a short signal, buy signal, whatever. And it gave a short signal on August 9th, and I actually went ahead and actually shared it with elite members live the moment it was alerted, because I had that alert set up on my end anytime I get a short or a long signal on the market. And here we are, working beautifully. I mean, sure, it's not going to be perfect all the time, but you could see even in the past, like back in end of March, we got a long signal on the S&P 500, and man, that was pretty much the beginning of a massive run. Right. So the Alpha Cross Evo, again, I'm not going to give away too much. It's very well explained, and the nuances in the masterclass. So I wanted to kind of do a little bit of a pull the curtain back for those that don't have access to it, that didn't even know what it was, or such a thing ever even existed. So a little bit of a showcase here. The Alpha Cross Evo has been something that I've developed over many years, tweaked, adjusted, and man, it's been kind of that, I don't want to say secret sauce, but it's been this extra assistance, this extra confidence thing that not only for me, but also for all the students of the masterclass as well. So it's a tremendous piece of kit. It's tremendous, and you could see it in action. And it applies to, of course, every stock, every chart. People actually use it for Forex and crypto, which is kind of a bad word, but really anything they use it. They use it for anything that you can bring up in TradingView that has a price, you can use it for. So it's interesting. We got that short indicator signal there. And then Chris, from August 9th to now, what are we at in terms of having actually, it's going to be hard for you to bring the measurement tool up. That's fine. That's
Well,
okay.
how convenient that I could just go back to my normal chart that
Okay.
everyone is used to. So you want it from August 9th to now?
Perfect. Yeah.
All right. So if you took it at the end of the day,
So
there you go.
2%. Yeah. Nearly 2.5% from the end of day peak to Friday's close. That's a sizable move in the S&P 500. Remember, this is the market, not an individual stock. The broader market pulling back 2% in roughly a week. That's sizable. Honestly, that's sizable considering we've had a massive run. So it doesn't mean that, okay, look out below, we're going to be seeing 3,900 or even 4,000 on the SPX, but it gives you that added little bit of confidence to show you, wow, okay, the indicator that's doing math, ultimately it's just doing math and collecting different data as price action continues, and then visually showcasing it for you on the chart, in this case via a long arrow, long signal, or a downward pointing arrow for short signal. And that is the gist of it. And here we are, down 2%. I do personally think there's a little more downside. To kind of move on from the indicator, overall macro, I think the markets are kind of factoring that potentially we might get another 25 basis point rate hike, let alone we're not getting a drop. Obviously, we're not getting a drop. I don't think there's anything that is signaling we get an actual drop in benchmark interest rate. So the market's now pricing that in. Earnings so far have actually been pretty good. Keep in mind the caveat is that many companies, many CEOs, CFOs, management, all kind of, I would say, sandbagged and kind of decreased their guidance, meaning they said, okay, the next quarter, the quarter after that might not be too good, might be a little bit of underwhelming numbers. So they kind of set the tone of that, and then it didn't end up being that bad. So, usually they beat, but you beat a number that's been lowered. I don't know, man. I don't know how I feel about that. So
Kind of sounds like stacking the deck to me.
yeah, a little bit, exactly. But that's how it's always been. It's nothing malicious or anything. It's just the fact, because they have to be transparent, and I get why they did see a slowdown. They did see the spending power of consumers to be lower, but that's not the case. The consumers are actually very resilient. We've touched on it before. They're pretty strong. Retail purchases, consumer discretionary purchases have actually been pretty strong. Even travel, all these kinds of things that people spend excess money on, all these industries are quite strong. So yeah, in a way, it's kind of stacking the deck, but they did beat. But if we look at deeper in many companies, their revenues are actually lower. So we've seen a slowdown in revs. We've even seen a slowdown or pullback in net profits for the companies that are profitable, that is. So not all is sunshine and rainbows if you look under the hood, so to speak.
Yeah.
So this pullback isn't surprising to me. For those that have been following me on Instagram, and even, of course, especially in Elite, obviously, in real time positions I have, plus my cash position in the account, which tells you pretty much everything there is to know. How I'm positioned is pretty much beyond everything anyone can say via words, because I show what I have, and that speaks volumes, right?
Definitely.
So I'm pretty much in about, let's say now, after a few position changes last week, about 80% cash in my trading account, which is pretty sizable. It's actually been on the higher end this year. And that doesn't mean I can't make money via existing positions. It doesn't mean I can't make money on the existing cash value, because in Elite, and especially masterclass students, know that we can utilize our account value, whether it's in cash or whether it's in different securities. We can actually utilize that to generate return via the strategies that I mentioned. So definitely able to really eke out an advantage. It's been a tremendous year for me, at least, and I'll share the performance actually in Elite in the coming week, and also share video footage, so it's not, so people know, like, okay, there's people out there, gurus, and I'm not gonna get too far into it, but I could tell you they just post screenshots, selected screenshots of like specific trades. But I shared some screenshots, but I'm gonna share a video literally right as I'm scrolling in the app.
Nice.
Show like, okay, here's the account value, here's the performance year to date. So it's literally indisputable. Okay, because again, transparency is king, and that's really what I live by. So tremendous year so far. But yeah, I think the market right now, I know you don't have your lines on this one, but I think we could definitely 43.50. We would kind of touch below that, but then it kind of market recovered a bit. Kind of closed pretty much flat on the day, but from the low where it opened, it recovered from the open, hence the green candle. But yeah, definitely a very, very bearish week. And if you look back, pretty much all of August has been bearish. And even when we go back to seasonality, August is actually kind of a bearish month from a seasonality perspective. And we have touched on that before as well, roughly.
Let me know down in the comments if you're watching this on YouTube, which view you like better. Now, of course, like Riz said, we can always put my lines on here. That's not a big deal. But do you like the more subdued colors for the candles, or do you like it lit up like a Christmas tree? Now, Riz was saying that it looks like it's Christmas every day, and that's how we want it in the market. If you ask me, we always want it to be Christmas in the market because well, that means that we're making money. So let me know down there which view you like better. Is this too confusing? Is there too much going on? Would you like it, more simple like this, or do you like the bright colors and all of Chris's technical analysis? Let me know down in the comments, and we can make that change because we want to make sure that you guys are happy with what you're getting.
Yeah, that's very important. Thank you, Chris, for that. That's great. I totally forgot about that. But yes, please, if you're watching, please let us know in the comments of the YouTube video which one you prefer. And for those of you that are watching live, feel free to let me know in the chat as well.
All right, well, let's take a look here at the breakdown of the S&P 500. And, Riz, you're saying that it's been a pretty bearish month, and you're not kidding here. Starting back here on August 1st, the big winners, those, indices or sectors rather that were outperforming have really been taking a hit. Tech now is actually, right there in par with communications, whereas it had been, ahead for quite some time, really kind of taking a dip down here after about the first week of August and really sinking down. And, even though consumer discretionary is up, here in August, we've definitely been taking a beating, especially this week. My goodness, from Monday until Friday, that was quite the big jump here from right around, about 32% down to 26. So, math is tough on stream, but I'm pretty sure that's right around a 6% drop. So definitely not insignificant. Of course, the market's down. We knew that already. But energy here still, even though it took a bit of a beating up till about the middle of the week, has started to rebound and starting to come back up. And some of those sectors that were, got above the zero line finally have sunk back down. And that's basically everything else, except, of course, for utilities, which is just getting absolutely demolished this year, currently down almost 10%. But financials, healthcare, consumer staples, real estate, all currently under the zero line. Riz, what are you seeing here? I mean, I feel like we've kind of talked about this, that if these sectors, these overperforming sectors like tech, communication, and discretionary start to take a hit, the market will go with it. And I think that's kind of what we're seeing.
Yeah, absolutely. The leading sectors being communications and tech, definitely pulling back has kind of put the market a little bit on notice, right? We know Apple pulled back significantly post earnings. That drop was blunted a bit because Amazon jumped so much and had a positive move post earnings. So once Amazon started to fade a little bit, we saw that along with Apple's continuation lower, really weigh on market. And usually it's pretty easy to see that this is kind of like classical mean reversion. We're seeing the leading sectors kind of normalize, revert to the average, to move closer toward the S&P 500 line, SPY, and then we see the other sectors. Generally, they would be moving up a little bit, but that would be more so in a sector rotation. That's not happening. This is still pretty bearish for all sectors, except I would say maybe energy. But you could definitely make a case that the underperforming sectors like energy, financials, real estate, healthcare, consumer staples, and of course utilities, they're all underperforming. And even though the market has pulled back, even though tech, consumer discretionary, and communication sector, they've pulled back a larger amount from the highs, the other underperforming sectors haven't pulled back that much. Right. So they're kind of floating. They're treading water, whereas some of the stuff that was very lofty, high flying, like tech and communications, that's taken quite a beating. Right. So usually this is a kind of a good way to be able to tell that what's a defensive sector compared to what's a more of a growth high flying sector. It's pretty evident to see if it's not already. I'll make it clear. You got communications, XLC, XLK, XLY being the big lofty sectors that were pretty much propping up the market and now taking a beating. And then you have the other stuff that's still kind of languishing down a little bit roughly, but not too much damage, right? And usually if we saw these sectors spike up significantly, utilities, healthcare, yada yada, and then we saw that in correlation with XLK, XLC, and XLY drop, I could make the conclusion easily that it was sector rotation, but that's not the case. This is not sector rotation. I wouldn't go as far as to say this is widespread contagion, but this is more of a risk reduction. And that doesn't mean because there's risk leaving markets from specific sectors like, tech and whatnot, doesn't mean it's going into the defensive stuff. It might just be going into cash, maybe other asset classes, but it's definitely not a sector rotation just yet.
That's some really good insight because we talked about sector rotation before. So, that's a really good thing to just kind of keep an eye on here, why we look at the different market sectors. So we kind of know what's going on because, yeah, we can look at the big, S&P 500, but what goes behind that? What's really driving the market? And that's why we show this chart. So that's some really good insights that you can carry forward. Let's go ahead and take a look here at a couple of the asset classes that we do like to keep an eye on. Now, obviously, oil was flying high, really kind of making a push for this 85.40 area that we've been keeping an eye on, but didn't quite get there on Wednesday. And we've had a bit of a pullback, but still a very bullish move here in oil. Obviously, that's kind of helping push the energy sector up a little bit. And then gold taking a bit of a beating this week, but not too bad, but I don't remember. It's been a long time since we've seen gold, down here around 1800. Let's see, the last time was in March, so several months over 1900, and now we've actually kind of sunk back down, which just tickles the bejesus out of me because I tell you, I know we harp on this all the time. Everyone's saying the dollar's crashing, buy gold, buy gold. Everybody's buying gold. Well, if that were the case, gold would just be going up all the time, but yet we see gold kind of pulling back here. So just be careful where you get your information, guys, because there's a lot of sensationalism out there. That's for sure. But yeah, Riz, this little pullback in oil here, I kind of feel like this is more of a, just a bit of a, I wouldn't say like it's a technical pullback per se, but just a little bit of a relaxing after all this buying, having a little bit of selling, profit taking going on there. Are you seeing anything going on in oil?
No, I think you're right. We're coming into the ending classical summer months of the for most of North America. So it's a little bit of a pullback, nothing major, a little bit of a cooling off, but I think the uptrend is still there. I'm personally not comfortable taking any position yet. Because there's especially the last week and a little bit more than last week, it's gotten a lot more interesting with opportunities in markets like equities. So that's where my focus is right now. Obviously, gold, I don't really care for much. I mean, it's good to see because it gives us a gauge and understanding of if there's people that are or institutions and pretty much retail as well, but primarily institutions, if they're taking completely risk off or they're expecting a contagion. We don't see that. They're just money is literally just leaving gold. It doesn't mean it's going into other asset classes. It just means it's being sold off, maybe even being shorted. But nothing to be drawn from a conclusion side of things for gold.
All right, let's take a look here at the bond yields and the dollar real quick. Definitely seeing some perking up here in the bond yields, especially in 10-year and the 30-year bonds, starting to perk up a bit more, while the 2-year is starting to kind of hold here. We're seeing more consolidation, I would say, from the 2-year, which I think is good. Obviously, we've had this inversion for quite some time, but it does look like the 10 and the 30 are starting to gain some strength here, and the yields are starting to climb back up and get a little bit closer to what we're seeing with those 2-year bond yields. And the dollar remains pretty solid here. Nice little recovery. Been pushing up pretty strong here over the last couple of weeks, so looking pretty good. Sure doesn't look like the dollar is failing to me. Riz, we've talked about the bond yields being a future looking indicator, I believe is the way that you put it, or forward looking indicator. There we go. With the 10 and the 30 starting to kind of perk back up here, is that kind of signaling the fact that the Fed basically said, yeah, we are going to keep hiking rates? And the bond market's kind of saying, okay, well, maybe these longer term bonds are going to be, a better yield.
Yeah, so I take it like this. The Fed hasn't completely gone and said we're going to raise, but we do know that based on current indications,
they're going to do it. We know they're going to.
Yeah, but I honestly, right now, odds are, before last week, odds were 25% of a rate hike in the next meeting, 25 basis points. But so like 25% odds, okay, of a 25 basis point hike. I think now, I haven't looked at the numbers this week, but I think now after this past week, those are a little bit higher. Number two, the bond market is once again signaling to us, regardless of the 10-year, 2-year, 30-year, regardless of the inversion, put that to the side. This movement up over the last week that's coinciding with the drop in equities tells us that the bond market continues to wave the red flag and say, look, danger ahead, danger ahead. Now, that doesn't mean we're going to see a crash or an economic collapse. It just means the bond market is signaling that, okay, we might see a weaker economy. How weak? No one knows. Maybe, right? But then on the flip side, we have, the other economists from different rating agencies. We have different economists from all over the place forecasting positive GDP. So there's a think of it like a mismatch here, right? One side saying something and the other side saying the opposite. Who do you believe? The equities market up until now were rip and roaring, right? The stock market was just going up and up. And even after this 2% pullback in the last week, which is pretty sizable, we're still up 13% for the year, right? We're still up about 13% for the year. So it's pretty sizable for a run, right? We're not back to all-time highs, but it's been a really nice significant recovery just year to date. And especially since March onwards, right? If someone bought March onwards, they'd get that. They'd be showing really pretty. And conveniently, the Alpha Cross Evo gave that long signal then too. But that's another point altogether. As far as the dollar also going a little bit stronger tells us as well that, okay, maybe rates could be held at these levels, right? So it's like when I look at these things, my job is, as a doctor, think of it, I'm not a doctor, but as an example, looking at different things as part of this body, which is the market overall, not just the stock market, the broader market overall, broader economy overall. I look at different parts of the body. What does it tell me? What's the pulse? What's the blood pressure? What's the sugar level? What's the cholesterol? How is this person's, how is their like eyesight? Are they reacting? Are they, cognizant of what's going on around them? Are they aware of their surroundings? I'm putting everything together and then I can make a diagnosis and say, okay, well, this is what can happen. Hence why I've been positioned the way I have, right? That's the best analogy I can get you. Don't get me wrong. I'm not a doctor. I'm not a medical professional, but just as an example, this is how we want to approach markets. And what I've said just now, the last few minutes, is one of the key things that separates me from all the other Joe Blow, day trader, go-getter pumpers out there. Fuck, like these guys, you can show them this and they're gonna be clueless. They're gonna have no fucking idea. I mean, they'll talk their face off about it, but they will have no idea what the fuck they're looking at. So that's what differs, right? That's understanding. And I always tell elite members and even mention in the masterclass, my job is to have the finger on the pulse of the markets at all times, and that's what I excel at. So the trading, buying, selling, holding, shorting, these are all things that we do specific to participate in the market, to position ourselves, but it's not a replacement of actually fully being in sync with the market, which I think, I'm not trying to blow, smoke up my own behind, but I think I have a good understanding of it. I think it's served me well. And for those that are, maybe a little bit on the fence, well, I'll show you what the performance is like. And then you can directly go back to this video and like, okay, this is how the risk is doing versus the market.
Yep.
And directly correlate and compare.
Yeah, for sure. It's something you're not going to get on a lot of other channels. And it definitely, again, if you haven't clicked the subscribe button, guys, you really need to. Please do that for me. I'd really appreciate it. Because we want to get you this information. We want you to have this. Yeah,
it's a shame. Someone will go on and give their morning routine. And they'll get thousands and tens of thousands of views, hundreds of thousands even, and then here we are. Obviously I'm not saying we're the best of all time or like, but come on, like, I feel like fuck, is it really that hard to I don't know, support our content? I'm not sure, to be very blunt, very honest. Yeah,
completely free to smash that button for me, so please do it. Because we want you to have this information so that you have a better idea of what's going on in the market. And like Riz is talking about, I've been in other places. We'll just put it that way. And I can promise you that these types of charts were not shared. And this level of explanation has not been shared. So please just consider joining us, even just here free on YouTube. I would really appreciate it. All right, so let's keep going. Let's talk about some of these dates here in the market because we've got one big one and it's coming up on Friday. Now, durable goods orders month on month, probably going to be a bit of a snoozer if you ask me. Not going to be a huge catalyst, but whenever Powell talks, the market moves. We've said this before, and it has served us well. We'll just put it that way. And he's going to talk on Friday around 10 a.m. Eastern time. So that is definitely something to keep your eyes and ears on, and just keep an eye on the market. I wouldn't necessarily recommend you do anything crazy position wise unless you've got a lot of cash. That's up to you completely. I'm not going to give you financial advice on that, but definitely Powell talking on Friday going to be a big date for the market, because that can push the market one direction or another.
Yeah, it's going to be interesting. It's not like one of those, it's not a Fed specific type of mandated speech. It's not about the consensus of different Fed members on interest rates. He's mostly going to be kind of talking freely as to his views and what he thinks, because Jackson Hole is where it's going to be happening. Jackson Hole, for those who don't know, it's kind of, think of it like an annual economic like a forum, like, get together, right? And of course, because he is the chair of the Federal Reserve, U.S. Federal Reserve, he's obviously going to be kind of like the headlining speaker there. So this is always kind of important. It doesn't mean he's going to say something that's going to significantly move markets. Not always. There has been times, yes. And usually, the market is very focused on what he says for however long his speech runs, and then they try and dissect every word, every statement, every phrase, and then you might see some volatility. It could be a choppy day, or it could pretty much be one of those days where nothing really happens as a result of it, right? Good or bad. So I've seen both, of course. So I don't draw too much into these external conversations that the Fed chair has. I've been alive and trading through a few of them, whether it's Powell, whether it's Janet Yellen, whether it's Bernanke. It's been a clown show ever since.
That's a good way to put it. Everybody enjoy the clown show on Friday, because that's definitely what it is. Now, if you're here on our Elite webinar, go ahead and start posting your questions. But I did get one come in from Jeff. He said he wanted us to take a look at NVIDIA going into earnings. So as always, he phrases his questions fantastic. He says he wants to discuss NVIDIA. Looks like it's sitting just below the 50 moving average. You're absolutely right, it is. But it has been resilient to the overall market, which is pretty fair. He was thinking about possibly taking a starter position, maybe going long on that. Wanted to see, they also wanted to understand how this moves defies basically what's going on in the market, because obviously, since about the beginning of August, the market has been pretty red. But overall, I would say that, well, let's measure it here. Let's see exactly how much NVIDIA has dropped since the beginning of the month. It has not been as much. Actually, no, it has. My numbers might be a little bit off there. Yeah, so it actually has dropped more than the market, because the market's down about 2%. So NVIDIA is definitely dropping a bit more than the market at this time. But Riz, how would you feel taking a long position going into earnings? Me personally, I'm a little hesitant, but where are you at on this?
Absolutely. Hesitant times 10. I would not take a long position personally. It's way overbought, overextended, fundamentals, technicals, you name it, kitchen sink. It's overdone. I would, if I'm feeling a little bit frisky, I mean, we'll find out, in Elite Live, depending on how I feel, it'll be fun. If I'm in the mood, I'm feeling good, I want to YOLO, or maybe I want to take like a more riskier trade. Again, I will reiterate that trading earnings catalysts are always a coin toss. They're very much a lotto ticket. So by no means am I saying like I can tell what's going to happen post earnings or how the results will be. But if I do want to play this catalyst and be okay with the risk that's associated with it and manage my position size accordingly, then yeah, if I had to, I'd go short. Personally, again, that's me. We know last earnings was a blowout, massive gap up. Like holy crap, like in a literally just turned it into $1 trillion company after that gap up, and it was just insane for such a large company to move 25% the next day was extraordinary, and it's been overvalued since. And instead of being 380, it's now went as high as 480, nearly 500, and it pulled back a little bit, but still way too lofty. Honestly, way too lofty. I mean, God help and be with those that want to go long at this level. But I mean, they could make money because, as we know, the market has been frothy. It doesn't mean it's going to completely revert and become sensible again, because we have seen some of these crazy high flying stocks continue to run anything to do with AI. And NVIDIA encapsulates pretty much both those buzzwords, anything to do with chipsets, semiconductors, plus AI. NVIDIA has been the kind of the showrunner of that, and that money is piled in significantly, as you can see. So very resilient. Yeah, it's moved down a little bit the past week, but the stock has actually been very resilient, and remained up here. So that's definitely positive for the bulls. But with this earnings catalyst coming up, man, uh, if I had to lean in a direction, it would be short.
That's fair. Let me know your thoughts on over under on how many times they say AI on the earnings call down in the comments. I'd love to hear your thoughts. I'm definitely going plus 10 on that. That would be my guess because you just say
Yeah.
earnings or
I
excuse
raise,
me, AI.
I raise you. I
You
raise you
raise? Okay.
probably plus 15.
Plus 15. Okay. Riz is going plus 15. Who do you think is going to win, guys? Let me know in the comments. Would really appreciate it. But yeah, that seems to be kind of the thing. How many times they're going to say AI in the conference call? It's kind of the running joke here. Get your bingo cards out. But okay, I got a direct message from one of our members here on the live webinar. Since it was direct message, I won't mention his name in the recording here. And if I could tap, that would be fantastic. Wants us to take a look at Yum Brands here. He went long the other day at 129.65. What is our thoughts? So yeah, it looks like here on this Friday kind of doji candle, decided to go ahead and get in. Obviously, there's dividend coming up here at about 60 cents per share, coming in at the end of the month on Monday the 28th. So that's something to look forward to. This is a risky one. This feels like a knife catch to me.
Yeah, definitely. I mean, a bit of a knife catch, yes, getting towards that 128 support. A little bit premature entry, but again, I'm not going to beat up on that entry. That's completely fine. We know that this 128 level has been a key consolidation zone. Just look back to December 2022 all the way to like February 2023. A lot of consolidation in that area. And then, of course, it kind of did have that move. And then we've got some consolidations around the 130 for 138 zone. But I think not too bad of an entry, not the most optimal for now, but I would see if it can hold above 128. I would definitely, depending on your risk tolerance and kind of risk reward ratio you're going for, I would maybe consider like a stop around 127, maybe 126 area if you really have if you have more wiggle room. And then obviously with the profit being around 136, 134. Just something basic, right? Just off the top of my head. Again, I don't know your position sizing and risk tolerance for the person that brought this up. But yeah, the dividend coming in is nice. Yum Brands isn't going anywhere. There's a really big global brand, whether it's restaurants, so on and so forth. So they're not going anywhere. Recession or otherwise, it might be impacted a bit, but people still got to get food, eat, and this level is a key area for sure. Break below 126, I would be a bit. It would get a bit hairy. Let's just say.
Definitely more concerning if it breaches that level. Yeah, this 128 area does seem to be really iffy. It definitely was holding here quite a bit, but yeah, break below 126. Yeah, that's bad. And we can see that it held this area before during this consolidation. So definitely seems to be pretty important. But, it is approaching being oversold. So, I can't critique your entry too bad. But, yeah, it definitely it could go lower. But if it can hold these areas, I think you should be all right. Absolutely. You're welcome. Glad you could give us that question. I'm not seeing anybody else typing at the moment. Let's just chat here for the last couple of minutes. Riz, is there anything that you're watching this week or anything you've got your eye on? Obviously, we talked about NVIDIA already, but is there anything else that people should be aware of?
No, NVIDIA is definitely big. When I think about it, let's see, we got Zoom. There's this app that we're using after Monday's close, they report earnings. So let's see. I'm not gonna probably play that, but just something meta there, just sharing for that. But we got the smaller companies, right? We got the big stuff that's already done. As we know, this is literally the last kind of quote unquote earnings week, so to speak. After that, it's all whatever that's kind of out there is just But yeah, NVIDIA being the biggest one.
We did get another question come in. This feels like this is every webinar. Wants our thoughts on Tesla getting absolutely annihilated
Oh my
here.
God.
I did not do that.
That
But
yeah,
that
that's crazy. This is what someone was talking about in Elite. Remember? They saw Elon coming up.
oh, yep,
They
that was it.
mentioned this in the chat, and then everyone was like, some of us were like, What are you on?" And then it was true because someone else brought it up.
That's
So
freaking hilarious. I love that.
that's a nice little Easter egg there. That's awesome.
There we go. You got to see it live, guys. I hope you enjoyed that. Rewind it. Feel free to watch it again. But yeah, I kind of feel like Tesla stock right now is up in smoke, pretty much similar to that little Easter egg we had just there.
Yeah.
People must be questioning what Elon is smoking on the Joe Rogan show as of late. But yeah, we're definitely oversold here, really being sold off here pretty hard. But yeah, this one's not going so hard, so hot, excuse me. Now, I know that, of course, Tesla has always been a flighty stock, for lack of a better term. It runs on hype, on tweets, or what are we calling them now? X's, whatever you
Um,
want to call them. But yeah, Riz, Tesla, what is going on here?
Big sell off. We did have a short. I'm glad we made some money on the short. I love it. No short anymore. Closed it for profit. Could have eked out more, obviously, but I was okay with it. I think, yeah, this is very bearish, pure waterfall down. Again, we've seen this happen. It runs up big, and then when it gives way, it just gives way altogether. So this is it's part and parcel of the stock. I think it's like a feature baked into the stock. People love it for those that want to speculate or take more high risk, high reward setups. And this is one of the most traded stocks on the market, obviously, from a stocks and option standpoint, even. So I'm not out there. I'm not here because of what I've already traded, because I've already shorted. I've already gotten out. I'm not going to try and force another entry in short. But on the flip side, I'm also not taking the long just yet. I'm keeping an eye on it. Keep an eye on that 200 area. That's a key pivot zone. It has been a prior resistance, which can act as a support now. So keep an eye on that area. And Chris is also moving that up as well. Beautiful. Again, it's slightly above that. I think it's that 200-day moving average, Chris. White line. Yeah. So it will be interesting to
Yes.
see. It will be interesting to see if it does get the way there. But 215, whew, from a high of 300 this year to 215 is quite the haircut. And of
That's a
course,
beating.
keep in mind it's going to be very much based on the market as well too. Like you see everything else sell off, Tesla is going to be there with it, right? And if Tesla has a massive, massive move, you can also rest assured, because it's one of the larger companies in the S&P 500, it's going to also have a little bit of a downward pressure on the broader market.
Yeah, when it goes big. That's really the only way I can say it with Tesla. And it just likes to run, and it likes to run both directions. So I would say with this, until you've got a confirmed breakout on something, or breakdown, as far as that's concerned, I would be very careful positioning yourself in Tesla. But that's just me and my opinion. You, of course, need to make your own decisions when you're making a trade, because we're not here to give you financial advice, just our thoughts for educational purposes only. Has Apple found a floor? Let's take a look at good old Apple. It kind of looks like it, but of course we have to keep the broader market in question here with Apple, because Apple being the biggest portion of the S&P 500, at least it used to be. If I'm pretty sure it still is. If the market's going down, it's going to bring Apple with it. So the real question is, has the market found a floor yet? And from what we talked about earlier, I would say that's still in question. There's still room to go, in our opinion. But from a technical standpoint, yes, it does look like Apple has kind of bounced off of this 171 area, 172, has kind of held up. I need to back it out a little bit to see how historically relevant that is. Not super relevant. I would say there aren't too many major pivot points, though. Here in this area right here, it was consolidating around that area. Riz, what are your thoughts on Apple?
Yeah, definitely an interesting level. I was eyeing it for a potential starter. I felt like it was a little bit too frothy at prior levels, even around 180. So I welcome this drop. I would like it personally to go lower. I think around 160, anytime below 170, I think it gets a little bit more interesting. Friday's kind of move was assuring, obviously, from a bullish standpoint, but we've seen that happen before, and then it just gives way the following few days. So by no means is this enough to be able to say, okay, yep, it's found a floor. by no means is that enough. We need more confirmation. I feel like a break below 172 can lead us lower. And as Chris intimated that, yeah, if the market pulls back, this will too. And vice versa is true as well. If Apple has a really bad day, it's going to also drag on the market because it's the largest company and the S&P 500 is market cap weighted. So Apple is, with the most exposure to the index, will definitely move the index the most. So it'll be interesting to see how this week goes. We don't have too many like major catalysts from an economic macro standpoint. It will be interesting because I think we're going to be in the third week of August. We know August seasonality I mentioned earlier is roughly a little bit of a bearish month. We are going to then, as we head into September, it's going to be the last month of third quarter. Like, wow, like that's crazy, right?
Hard to believe.
Yeah, I'm already grieving the end of summer, and it's not end of summer yet, but I've already started the grieving process.
Well, it takes time, and you kind of go through ups and downs, just like the temperature and the stock market, as that may be. So I want to thank everybody for coming out. An absolutely amazing webinar, as always. I hope you really got something out of it. And if you did, let us know down in the comments or by clicking that like or dislike button. Either one helps. So click them both for me if you so desire. And we'll see you in the market on Monday.